It's a nice time we meet for a session of advanced financial reporting. So for today, we are going to talk about foreign subsidiaries. This is under a topic called business combination, or we call it group accounting. So when we talk about foreign subsidiaries, that is under International Accounting Standards 21. So the main thing you need to know is that we are going to deal with subsidiaries which are on another jurisdiction. So you know that when we talk about subsidiaries, these are investee companies acquired by the parent company between the percentage of 51 to 100%. So you will find that, let's say, for example, a parent company is in Kenya, then it acquires a subsidiary in the United States of America. So remember that when we do consolidation, when now the parent, to be more specific, when the parent will be doing consolidation, it has to translate the operations of the foreign subsidiary to that of a reporting entity. So when I say reporting entity, it's all about the parent company. So when we talk about foreign subsidiaries, that is what you need to know, of which I've said that the operations of the foreign subsidiary must be translated to the currency of the parent company before consolidation is carried out. So in order to understand this well, I have prepared some soft copy notes, which I will share, we go through, so that we can be able to know when the parent is exchanging the transactions of this foreign subsidiary, which rates is supposed to use, because we have various elements in the income statement and the statement of financial position. So these are the notes. So these are the notes concerning that foreign subsidiaries. So they say that, so foreign subsidiaries, it's all about a parent company may operate a foreign subsidiary due to various reasons. So it can accept to go for a larger geographical area. So that is one of the reasons. So expanding the area of operation so that it can be able to satisfy its customers in different areas. So there's different reasons why we can operate in a larger geographical area. So anyway, that we have various reasons. So for consolidation purposes, the parent company should translate the operations of the foreign subsidiary. That is what I've said. So we have various methods of translation, which are two. The first one is the presentation currency method, and we have the functional currency method. So when we talk about presentation currency method, we say this method is ideal for translating operations of subsidiaries which are deemed to be independent in nature. Then the International Accounting Standards 21, I really recommend the use of this method because you will find that many subsidiaries are assumed to be independent. So you need to understand that between presentation currency method and functional currency method, presentation currency method is highly recommended by the relevant standard, which is International Accounting Standards 21, because it translates subsidiaries which are independent in nature. And you will find that most of the subsidiaries, the foreign subsidiaries, are independent. So now under that method, which we call presentation currency method, we have various rates which you are supposed to use in order to translate items of the income statement and the statement of financial position. So right now, incomes and expenses, you use the average rate. Assets and liabilities, closing rate. Dividends, spot rate. Depreciation, rate used for non-current assets. Then capital and reserves, historical rate. So when we talk about closing rate, because in this scenario now, when you will be going to a question, so you will not be told that this is the closing rate, but you will be given date. Spot rate, again, you will be given a certain date. The same with historical rate. The only one you will be told the average rate is this, is the relevant average rate which will be provided. So you need to understand what is a closing rate, what is a spot rate, and what is a historical rate. So which I've said is crossing rate is the rate which was prevailing on the date when statement of financial position, this one means that way, SOFB, statement of financial position, was prepared or was to be prepared. Then spot rate, rate which was prevailing on the date of occurrence of a transaction. So for example, if you paid dividends on this date, let's say on 1st July of the year. So 1st July, so the relevant date, as mentioned when you pay dividends, that is the relevant date when the transaction took place. Historical rate is all about the date which was prevailing on the date. So it's all about the rate which was prevailing on the date when subsidiary was acquired by the parent. So remember that the parent is the one which acquires the other investee companies. So historical rate is at the date when the relevant subsidiary was acquired. Then we have steps for consolidating for a foreign subsidiary. So first, you have to translate the income statement. So remember that the income statement you are going to translate is that of the foreign subsidiary. Next, you translate the statement of financial position of the same foreign subsidiary. So you translate, remember that you are translating to the reporting currency. Reporting currency is the currency where the parent is based. So for example, if the parent is in Kenya, subsidiary is in the United States. So you have to translate the dollar to Kenyan shilling. Then step 3, you have to determine exchange reserve arising on translation. Then determine and retranslate. Step 4, you determine and retranslate the goodwill on acquisition of foreign subsidiaries. Step 4, you have to determine goodwill. Then once you determine goodwill with the foreign currency, after you have determined the goodwill with foreign currency, then you have to translate, of which you will translate as at the time when the subsidiary was acquired, and you will translate as at the date when we are preparing the books. Then finally, you prepare the relevant statements. So in order now for the reference purposes, we have 3 questions, but I will do one. We have December 2011. This is concerning CASNEB exams. That is advanced financial reporting. So we have December 2011 question 1, December 2013 question 1, and we have November 2016 question 1. November 2016 question 1. So to start with, I will start with the latest one, that is November 2016 question 1. I will start with November 2016 question 1. So I will share the same. So the November 2016. So I'm displaying the question for November 2016. So this is the question, November 2016, question 1. So the question reads, H Limited, a public limited company based in Kenya, owns 75% of the ordinary share capital of S Limited, a public limited company based in Rwanda. H Limited acquired S on 1st May 2015 for 1,200 Rwandanese franc, when the retained profit of S were 800 million. The functional currency of H Limited is Kenya shillings. The functional currency of S is the Rwandanese franc. S Limited has not revalued its assets or issued any share capital since its acquisition by H Limited. So the following financial statements relate to H and S. So you can see that H, which is in Kenya, acquired 75% of S Limited, which is in Rwanda. So it acquired S on 1st May 2015, of which S currency is Rwandanese franc. So as at the time of acquisition, retained profit were 800, that is Rwandanese franc. So the functional currency of H is Kenyan shillings. The functional currency of S is Rwandanese. Then you are told that S has not revalued its assets or issued any share capital since it's acquisition by hedge. Then you are given statements of which they have provided us with a statement of financial position, of which you know the elements of a statement of financial position, assets, equity, and liabilities as provided there. We don't have to read one by one. It would be wastage of time. And then income statement, you know, it's all about revenues and expenses as given, as shown. So my main concern maybe is the additional information. Additional information number one, you are told that goodwill is reviewed for impairment annually as at 30th April 2016. The impairment loss on recognized goodwill was 1 franc 42 million. So that is the relevant goodwill, which was impaired as at 30th April 2016. So you are told the impairment, which is 42 franc. So that is in terms of millions. Note 2, you are told that during the year ended 30th April 2016, S Limited purchased raw materials from H Limited and denominated the purchase in Rwandanese franc in its financial records. Details of the transactions are shown below. So when you see an additional information of this kind, remember this concerns goods which are sold between the group members, because now for this scenario we have the parent and the subsidiary. Those are the group members in short. So if H sold to S, or we have said S purchased raw material, these are goods. So now the main thing you need to ask yourself when this intergroup sales of goods is all about, remember that the entity which was selling sold at a profit. It can be profit markup or margin. The entity received the goods and paid. So in this scenario, H sold to S, of which S received the goods at a selling price of 60, and they paid that amount to H. But now, did S resell the goods by the end of the year? That is why you are told here, you can see in this here, you are told that as at 30th April 2016, which is the end of the year, a half of the raw material purchased was still in the inventory of S. So the goods S received from H, by the end of the year, they have not been disposed entirely. So since S has not disposed all the goods he received from H, it means that out of the goods which are remaining, there is unrealized profit, of which to get the unrealized profit, which S never realized, because he never resold all the goods he received from H, I will take the unsold goods, that is the formula, times profit margin, times the profit margin. The unsold goods times the profit margin. So if I have been provided with a profit markup, I have to change. For example, if you are given a markup of A over B, margin will be A over B plus A. So which means that you add the numerator to the denominator. For example, if the markup is a half, which means, for example, 50%, to change it to margin, you say half plus the 1 under the denominator. So it will be a third. So if the markup is a half, margin will be a third. If markup is 2/3, margin will be 2/5, because I have added the 2, which is the numerator, to the denominator. So if we have 2/3 as markup, our margin would be 2/5. That is fine. So the only thing you check when there's intergroup sales of goods is all about unrealized profit on stock on the relevant goods, that is. At the same time, the relevant amount selling price, that is an intergroup sales. I will tell you where to adjust. Even that unrealized profit, I will tell you where to adjust. Note 3. H Limited issued an interest-free loan to S Limited of Kenyan shillings 50 million on 1st May 2015. The loan was repaid on 31st May 2016. S Limited included the loan in its non-current liabilities. So remember that our financial year ends on April, of which by the end of that April, it means that this loan has not been paid because it was paid 1 month after the end of the financial year. So which implies that by the end of the year, this amount was still outstanding. And when there is an outstanding amount, intergroup owings, that is the better name, we always forgo the amount. So the group member, when there's an intergroup owings between the two entities, that is the parent and the subsidiaries. For example, the subsidiary owes the parent, or the parent owes the subsidiary. So what we always do, that amount is not supposed to be carried forward to the next financial year. That amount is forgone in the current year. So how do you forgo an outstanding amount? What you do, you adjust two accounts, that is the debtors account and the trade payables or the creditors account. So you debit your trade payables account, which means that you subtract your trade payables account, then you credit your trade receivables account, which means that you have again subtracted. That is fine. So on this scenario, they were very specific, as included the loan in its non-current liabilities. So we will subtract this one only under the non-current liabilities. But if they never mentioned that it was included in the non-current liabilities, we could have adjusted two accounts: debtors account, creditors. Debit creditors account, credit debtors account. It's like subtracting both sides because I will not be using double entries. So, but for this scenario, I've said you subtract under non-current liability only because they were very specific that this amount was included there. Note 4, the fair value of the net asset of S Limited as at the date of acquisition is assumed to be the same as the carrying amount, or we call it the carrying value. So when they say this, what you are supposed to do, or what you are supposed to know, is that they are testing you something concerning a revaluation. So we always say that the revaluation is the difference between the fair value, or we call it the market value, and the carrying amount, or the book value. So when there's a difference between the book value of an asset and the fair value of an asset, we say that there's a revaluation gain. So they can test you in 3 ways, of which they can provide the fair value and they can provide the carrying amount or the book value. So you take the two figures, you subtract, and you get the revaluation gain. Again, they can say that the fair value of the asset was in excess of the book value by a certain figure. So which means that the fair value, obviously the fair value would be in excess of the book value. So by a certain amount which will be given. So you know, again, that is revaluation. Or they can say that the book value was below the fair value by a certain amount. So again, that is a revaluation gain. So on this scenario, they say that the fair value of the net assets of S as at the date of acquisition is assumed to be the same as the carrying value. So which means that there was no difference between the fair value of the net assets of S assets and the carrying amount. So there was no revaluation because there was no difference between the fair value and the carrying amount of those assets of S Limited. Number 5, H Limited paid a dividend of Kenyan shillings 80 million during the year ended 30th April 2016. This dividend had not been included in its company's income statement. So we will include. Then number 6, the corporation tax rate is 30%. Corporation tax rate is 30%, it's fine. Number 7, it's the group policy to value non-controlling interest at acquisition at its proportionate share of the fair value of the subsidiaries identifiable net assets. Then note 8, the foreign exchange rates are relevant to the financial statement. So this is what I mentioned about exchange rates. You need to know which is the closing rate. You need to know which is the spot rate. But for spot rate, I said that one, it would be more specific because it's all about understanding what spot rate means. But for closing, you need to know and the historical. At the same time, even the spot rate. Because I said the closing rate is the rate when the statements of financial position are prepared. Like now here, we are going to prepare our books as at 30th April 2016. So which means that 2.1, this 2.1 is the closing rate. Another rate is the historical. Historical rate, I said, is the rate which was prevailing when the subsidiary was acquired. So on this case, you can see up here when the question, at the question where it was starting, they said that the subsidiary was acquired on 1st May 2015. It was acquired 1st May 2015. So which means that that is the date when the subsidiary was acquired. So as at 1st May 2015, it means that this is the historical rate. Then for average, you are told is 2. Then for spot rate, you know that spot rate is as at the date, the relevant date when the transaction occurred. For that one, we will just be guided as we continue with the question. So the examiner needs you to do the income statement and the consolidated statement of financial position. So the first thing we have to do under these foreign subsidiaries, this question of November 2016, is all about we have to translate the income statement. So we talk about translated income statement. So the translated income statement, so remember that we are translating the foreign subsidiary. So it was in terms of Rwandanese franc, so that we have a rate here. Then once we translate to Kenyan shillings. So that is what we do. So of which this is what we translate. So this is our income statement. So we have revenue, of which revenue, we remember that we are translating the operations of S. So we are translating the operations of S. So revenue is 1420. So now the main thing you have to identify is that you know that income statement items, we use the average rate. So of which in the question, the average rate was, of which we have already talked about it. So the average rate as given in note 8, it's 2. So you can see there the average rate for the end of 30th April 2016. So of which they are saying that Rwandanese francs to Kenyan shillings. So which means that these rates you have here, they are the Rwandanese. Like now we have 2 Rwandanese francs. That is what they mean. So you need to know how to interpret this. So what you have there is 2 Rwandanese francs to 1 Kenyan shillings. That is what they mean when they say Rwandanese francs to Kenyan shillings. So what you have, because now they were never specific which is 1 Kenyan shilling or which is the 1 Rwandanese. So the one they have started with here, Rwandanese franc to Kenyan shillings. So these are the Rwandanese to 1 Kenyan shillings. So if they could have mentioned maybe to be specific 1 Rwandanese, I could have said that these are the Kenyan shillings. But since they have not said, they have just provided the relevant currencies, the one which is starting is the one which is given. Then the other one which is on the end, we say is 1. So that is why I've said 2 Rwandanese francs to 1 Kenyan shilling. So which means that in order to convert our 1420, it will be on this side. So which means that 1420, we have to divide. We have to divide. So we'll divide. So everything, when you will be converting to Kenyan shillings, that is from Rwandanese, you would be dividing. So 1420 divided by 2. So 1420 divided by 2.
$710.
So that is 710. So we continue to the next item. So the next item is concerning cost of sales. So the cost of sales, if you can check on that income statement, is 960. So the same we translate with 2. So you take your calc, you divide 960 by 2. So 960 divided by 2.
958.
So 960 divided by 2, that is so this is 480. So if we subtract, that is 1420, that is given. So the 1420 minus 960, this is 460. Then 710, we divide by, that is we minus, not we divide. 710 minus 480, that is 230. So which means that this is a gross profit. Then we translate the next item, which is as given in the income statement, which is distribution and admin expense. It's all about distribution and admin. So for S, it was 200. So again, we divide by 2 because we are using the average rate. So that is 100. So which means on this scenario, as per the equation, we are getting profit from operations. Profit from operations. So which means that this is 260 and this is 130. Then after that, we talk about interest receivable. But interest receivable under S, it was not there. So we talk about interest payable. So interest payable. So the interest payable is 20. We divide by 2, we get 10. So remember that this one is subtracted. So on that case, we get 240 as given. Then this is 120 as provided. So that we get profit before tax. Profit before tax. So after profit before tax, we talk about income tax. So the income tax is all about 90. We divide by 2, we get 45. And that is fine. So which means that profit for the year will be, profit for the year will be 240 minus 90, that is given 150. And this one, 120 minus 45. This one is 75. That is fine. So which means that we have translated the income statement, and that was step number 1. So this is step 1. This is my first step. So which means that we have translated the income statement. So this is the income statement we have translated. So the income statement of S. So we move to the next step. So the next step now, we translate the statement of financial position, again, of S. So these transactions I will be translating as my next step, step 2. So step 2, we talk about translating statement of financial position. So statement of financial position. So we talk about, remember that it was in Rwandanese franc. We talk about the rate. Then when we translate, we have the Kenyan shillings. So as my past paper, because I have the hard copy, but again, I have displayed which items we are going to translate. So I can see from the statement of financial position, we have the assets. Of which the assets, we have the property, plant, and equipment. The property, plant, and equipment in S is 1460. So of which we are going to use the closing rate to translate the assets. We are going to use the closing rate to translate the assets. We are going to use the closing rate. So we need to identify the closing rate, because I said the closing rate is the rate when the relevant statements are going to be prepared, of which on this scenario, the statements are prepared as at 30th April 2016. And as at 30th April 2016, the rate we have there is 2.1. So for all the assets, to translate them, I will be using 2.1. So 2.1. So remember that we divide. I already explained why I am dividing when I'm translating from Rwandanese francs to Kenyan shillings. So divided by 2.1, so 1460, that is 695.24. I'm getting 695.24. The next item given in that statement of financial position of S is investment in S, but that one is not there. Loan to S is not there. So we have current assets. We have the current assets. So for the current assets, it's all about 1020. It's all about 1020. So we translate by 2.1. So we say 1020 divided by 2.1. So that is 485.71. So 485.71. That is fine. So up to that point, we have the total assets. We have the total assets. So total assets, the figures for S. So this is for Rwandanese, this one is given. Then for the other one, I need to add 695.24 plus 485.71. So this is 1180.95. Then we talk about now equity and liabilities. We talk about equity and liabilities. So for the equities and liabilities, we have the ordinary share capital. We have the ordinary share capital. We have the ordinary share capital. So for the ordinary share capital of S is 320. So for the ordinary share capital, I said this, equities and reserves. Equities and reserves use the historical rate. And the historical rate is the rate which was prevailing as at the date when the subsidiary is acquired. So equities and reserves use the historical rate. And the historical rate I've said is the rate which was prevailing as at the date when the relevant subsidiary was acquired. In our question, S was acquired on 1st May. As given, this is not guesswork, but as provided. So we are told that up here, you are told that H acquired S on 1st May 2015. On 1st May 2015 for 1,200. For 1,200. So I'm concerned with that 1st May 2015, so that I will check as at 1st May 2015, which is the rate, and that would be my historical rate. So 1st May 2015, this is 2.5. So which means that all the equities and the reserves, I will be using 2.5. So 320 divided by 2.5. So this is 128. That is 120. So the next thing is all about share premium. Again, share premium, use 2.5. That is 200 divided by 2.5. So 200 divided by 2.5, that is 80. Then the next thing is all about retained earnings. But now retained earnings, you need to do this. So for retained earnings, you can't record what you have direct, but you need to consider the pre-acquisition retained earnings. So for the pre-acquisition and for the post-acquisition. So for the pre and the post. So for pre-acquisition, it means that is as at the date when the subsidiary was acquired. That is pre-acquisition. It means as at the date of acquisition, which means that as at 1st May 2015, the retained earnings was, so we can check in our question, it is given above here as at 1st May. So they say the H Limited acquired S on 1st May 2015 for 1.2 Rwandanese franc, when the retained profit of S were 800. So it means that that is 800. So this is 800. So again, you divide by 2.5 because that is an equity item. So 800 divided by 2.5. So that is 320. So that is 320. Then for the post, remember that to get the post-acquisition retained earnings, post-acquisition, you take the balance carried down. You minus the balance as acquisition. So the balance carried down, which means that it's the balance of the retained earnings by the end of the year, which is 30th April 2016. And we know that the statement of financial position is prepared as at 30th April 2016. So which means that the 950, this 950 which is given here is the one which is the balance carried down at the end of the year. So I will take that minus the 800 as at the time of acquisition. This 800. That is how you get the post. So you take the balance carried down of 950 minus the balance as at the time of acquisition. So I'm getting 150. So for the post-acquisition, it doesn't have a balancing figure. It doesn't have an exchange rate or a translation rate, but I will say my answer here will be a balancing figure. So that one will be the balancing figure. Then what I will introduce, which is not there in the statement of financial position, is what we call exchange reserve. So you can see we are done with these three. So I have to introduce something which is not here, which is the exchange reserve. I have to introduce that. So I will introduce exchange reserve. And in order to get this, I have to do step 3. I have to do step 3. So that one I will do later. So we have to continue now. So let us move to the other items. The other items is concerning non-current liabilities and the current liability. So the non-current liability, for the non-current liabilities, I have 410 as given in the question. So 410, remember this one I have to divide with 2.1 because I said all of the assets and liabilities use the closing rate. So 410 divided by 2.1. So that is 195.24. So I have 195.24. So the last thing is all about the current liability. So the current liabilities, I have 600. So current liabilities is 600. So 600 again divided by 2.1. 600 divided by 2.1. 285.71. 285.71. That is fine. So up to that point, I can get the total because this one is supposed to be 2480. Of which that is fine. But for this, remember that we are missing two things here. We don't have the post-acquisition retained earnings and the exchange reserve. So now we move to step 3 so that you can get the exchange reserve. So for the exchange reserve, which is step 3, so this step 3, so what we have to do here, you do this way. You talk about translated net assets, translated net assets. So you can say translate net assets, that is the correct one. Translate net assets at the closing rate. Then you will say translate opening net assets at the opening rate. So the net assets, the closing net assets, remember this is all about the equity items I will check from the question. So I will go to my statement of financial position, of which my net assets, this is the total net assets. Closing net assets, the 1470. So they are made up of ordinary share capital, share premium, and this retained earnings. So the 3. So they make up to 1470. So you talk about 1470. So you translate that at the closing rate, which is 2.1. The rate which we use to translate the assets and liabilities. So you say 1470 divided by 2.1. So this is 700. Then after that, you talk about opening net assets. So if you have a closing of 1470, remember that you can get an opening here, because remember this one includes, it's all about equity items, which is ordinary share capital, retained profit, and we have talked about share premium. So in order to get the opening net assets, we just subtract the profit for the year, and the profit for the year is the 150 from the income statement. We have to subtract that. This is the profit I'm talking about. So here the profit for the year is 150. So we have to subtract from the 1470. So if you subtract that, 1470 minus 150, I'm getting 1320. So I divide with opening rate. So remember that our financial year was ending on 30th April. So which means that it was starting on 1st May. It was starting on 1st May. So 1st May, the relevant rate which is given in note 8 is 2.5. That is now the opening rate as at 1st May, because our financial year was ending 30th April 2016. So it means that our financial year starts on 1st May 2015. So which means that the rate there, which is the opening rate, is 2.5. So I'm getting 528. So we can see that after translating on the closing, the closing, this is supposed to be closing net assets. What we have translated there is the closing net assets at the closing rate. Then we have translated the opening net assets at the opening rate. So we can see there is an exchange gain of which amount? So you take 700 minus 528. So I'm getting 172. Then we have to raise the one which is recognized, the one which is already recognized in P&L. So remember that the one which was recognized in P&L is the 75. We have to subtract the 75. This one, when we translated this income statement, we got a profit for the year of 75. So that one we have to subtract. So 172 minus 75, I'm getting 97. I'm getting there 97. So which means that here, under this exchange reserve, I will say we have 97. So in order to get this post-acquisition now, which I'm saying the balancing figure, I will add the other items. This one, and this one. Remember that the assets are supposed to be equal to the liabilities, which means down here is 1180.95. So once I add the others, then I subtract from 1180.95, I will get my post-acquisition. So I will take 128, I will add with 80, plus 320, plus 97, plus 195.24, plus 285.71. So if I take 1180 minus 0.95 minus answer, I'm getting 75. So I'm getting there 75. So that is how you are supposed to do the translation of the relevant statement of financial position. So now step 4 is all about goodwill. So first we have to compute goodwill using the foreign currency, of which in this question I have to use the partial method, because you need to know that when we do goodwill, you can either use the full method or a partial method. That is the two methods we always use. So but you cannot use both of them at the same time. But maybe if there is more investee companies, you can. So for this scenario, in order to use full method, obvious, the non-controlling interest must be mentioned at its fair value. That is the case when you are supposed to use full method. You must be given the fair value of non-controlling interest. For partial method, there is nothing like fair value of non-controlling interest. Then the goodwill arising from the use of full method is attributable to both the parent company and the non-controlling interest. For the partial method, the goodwill is only attributable to the parent company. To understand this practically, you can check. There's a video I've done in my YouTube channel specifically concerning goodwill. But anyway, that is what you need to know. So of which goodwill is all about purchase consideration. We say purchase consideration minus the share of net assets. So the share of net assets acquired. So in this question, there was nothing like fair value of non-controlling interest, which was given. So which means I have to use the partial method. So I will start with the purchase consideration, which is also called cost of investment. So when S was acquired, they paid how much? So I will check on the question. So at the start of this question, they told us that they paid a certain amount. So they said that they paid 1.2. So H Limited acquired S Limited on 1st May 2015 for 1.2. For 1.2. That is fine. So this is 1.2. So remember that I'm talking about here, this is in terms of Rwandanese francs. Then I have to raise net assets, share of net assets. So the share of net assets I have to subtract is just what we have done. So for the net assets, this is what I will use. I have to take my total of these items. Because we are already given in the statement of financial position, I can just pick direct from there. And that one can be easier for you. So let's go to the statement of financial position so that I can use those ones. So let me avoid using the one which is given there. So this one. So for the net assets, I have to use the 1470. So because it involves ordinary share capital, share premium, then retained earnings. But now retained earnings, this one was it as acquisition date. So this one would disqualify us from using 1470. So I will be using specific items, 320, 200, and this one, retained earnings. Remember that when you are doing goodwill, it must be as acquisition date. So we have 320, 200. So that is fine. So I will say this. So I have ordinary share capital. So remember that it was 75% subsidiary. So 75% of the ordinary share capital of S as per the statement of financial position of 320. Then share premium, 75% of 200 as per the statement of financial position. Then we have retained earnings. But when you are doing retained earnings, this one must be as acquisition date. As acquisition date. So which means I will take 75% of the 800. I know you would ask yourself, where is the 800 coming from? So the 800 is given because they said as at 1st May, when the question, at the start of the question, so they said H Limited acquired S on 1st May 2015 when the retained profit of S were 800. So when you are doing your goodwill, you need to know that the retained earnings you use, even the revaluation reserve you use, must be as acquisition date when the relevant investee company was acquired. Right now, in this scenario, when S was acquired, the retained earnings was what? 800. That is fine. And remember, generally, goodwill is computed as acquisition date of the relevant investee company. So let me use the calculator. So 75% of 320. So this is 240. Then 75 of 200. This is 150. Then 75% times 800. So this is 600. So I have to subtract from what I have as a purchase consideration. So I'm getting here 210 as my goodwill. So remember that is in terms of foreign currency. So what you will do now, you translate. So translate goodwill, asset, acquisition date. Then again translate goodwill. Asset, as at the date of the statement of financial position. So remember that we are going to prepare the statement of financial position as at 30th April 2016. So acquisition date was 1st May 2015. So we take 210 divided by, I think it was 2.5. And this one is 210 divided by 2.1. So 2.5 is the time when the subsidiary was acquired, so which is 1st May 2015. So 210 divided by 2.5. So this is 84. Then 210 divided by 2.1. I'm getting 100. So again, you can see there's an exchange gain of 16. An exchange gain of 16. An exchange gain of 16. So now you need to know that now what are the exchange reserves to take to the statement of financial position? Exchange reserve to the statement of financial position, SOFB. So what you do, so you say from operations. So remember that when we did from operations, we got 97. So this is what I'm saying. Then from goodwill, we have the 16. So which means that the total here is 113. But remember, we have to raise the share of NCI. We have to raise NCI. So for NCI, I will take 25% times 97. Why not the total? I'm not taking 113 because remember that when we did our goodwill up here, we used the partial method. We never used the full method. And we know that when you are using your partial method, goodwill goes only to the parent. There is no element of NCI. There is no element of NCI. So for that one, goodwill goes to the parent. So that is why it's not affecting the 16. So this 16, there is nothing which is going to the non-controlling interest. That is why I'm only using the 97. So 0.25 times 97, that is 24.25. So you subtract so that you get now the relevant exchange reserve. When I will be doing my statement of financial position, I will record. So I will take 113 minus 24.25. So I'm getting 88.75. 88.75. So now once you are done with what we have been doing, which is concerning the workings, and that is the bad thing for foreign subsidiaries. So for foreign subsidiaries, you have to do these steps if you want your work to be easy. But once you go through the work and you gain more knowledge and confidence, remember that you can do your statements without doing these 4 steps. And I will be showing you on how to do that. But now, this is the first way you are supposed to do for a beginner. But at the same time, even you are an expert, you can do the same thing. Step 1, step 2, step 3, step 4. Then after that, you present the relevant statements. But again, there's an option whereby you can do without doing the steps. So you can understand both. Then choose which is easier for you. But remember that the one which you go direct, you will not score the entire mark. So for the preparation of the income statement and the statement of financial position, please check part 2.